Portfolio Builder members, welcome to our Thursday webinar class. We've got a lot of normal folks, some new heads coming in. Let's see what we've got. I've got 12 people so far. I'm gonna go ahead and open up the mic since it's not too crowded yet. And Jerry, if you want to send me your link in the chat, we'll see if we can't get into that today as well. How's it going, everybody? Yeah, I'm trying to unmute everybody for a moment, and then we'll go into a presentation. All right. Well, okay, we got Jerry's link in there. Got Neil in there. Hey, Neil. All right, guys. Well, I'm gonna go ahead and mute everyone back, and we'll start the presentation. Okay, so the big event yesterday was to see whether the Federal Reserve would be raising or lowering interest rates, and they did neither, which is what I expected, and rather just stayed to their wait and see policy. And the market, the bond market, had been anticipating a rate cut, and so perhaps that is a bit of the volatility we saw. The action yesterday immediately after the announcement was bullish, only to see the market sell off somewhat violently at the close of yesterday and into this morning. So how did that affect our trade from Wednesday? And we got a quick question. Fred says, do you ever use spreads? No, I do not ever use spreads in this product. We'll talk about why. It has a very, very bad relationship to risk to reward. Yeah, guys, we're so there is an issue with VXXB not pulling up. So that's messing up the spreadsheet. This pulls from Google Finance, so I'm not sure why they are not returning the price for VXXB. For a quick fix until Google does start returning that, because this comes right from Google Finance, just put the price in, and that should fix itself as soon as Google Finance starts reporting that that price back to us. So that's what I did to make it work in my spreadsheet right here. Otherwise, if it's not pulling up the price, it does do that. So I'll make sure to get that optimized, but it's really up to Google Finance to actually report that number. Okay, let's see if it works now with VXX. Okay, there you go. So you're gonna have to I'll update everybody's spreadsheets. That's one nice part of our technology, so don't worry about it. I'll get into the active spreadsheets and do that. If you want to fix it yourself, here's what we had to do. We just go to this column B13, delete the B, and then say, okay, I agree to overwrite it, and that will fix that issue. So thanks, Jerry, on that. So from time to time, these tickers change. It happened to us on Tencent. They changed the ticker right there, so we had to do that in this as well. So that's one neat thing about our platform, is that we can go in there and tweak your software from you remotely. So let's see what other questions. So yeah, Fred, we don't like to do any kind of spreads because it creates a situation where you might have a high return, but you also have a huge potential loss. So whereas our program, we get really really antsy if we lose like $100 relative to a $30,000 portfolio. You know, to me, that's a big deal if we have that kind of loss, and it's rarely happening in our system. If you start messing around with spreads, you know, with any sizable amount of capital, in the best case, you're setting yourself up for losing anywhere from 10 to 30% or more, depending on what kind of spread you're doing in a heartbeat. So those become very directional and super risky. Now you're playing the try to guess where the market goes game instead of what we're doing, which we're going to get into here in a minute. Okay, so the Fed came out. Let's see, I think we still have some audios leaking through here. There we go. So the Fed remains on pause, as well as all the other central banks. So right now, money is very easy to get a hold of. And so we're not too concerned about a crash in the SPY right now because of that. That's number one. Number two, GDP growth in Q1 was huge, 3.2, which is 70 basis points above what anybody thought possible. So that's two. Three, we were expecting some terrible earnings, and they just haven't been that terrible. They've been actually really good for quite a few companies. So this all adds up to a picture where we're not in a panic mode at this point. And the other big thing is that it would appear there's going to be a China-US trade deal this month. So that's another reason we don't want to be overprotective in this period of time. So we'll look at that. I do want to know we went from, I think it was a 7.3% return to a 6.55 from just yesterday. So for anyone who thinks our strategy is completely bulletproof, of course, you know, there are risks involved with any kind of investment strategy. And we're going to talk about why our strategy is very careful about protecting capital. And so let's just take a quick look at the trade we put on. And I actually had a member write in to say that they had covered this position this morning and wrote a new one. And I'll talk about why we didn't do that in our portfolio right off the bat. Let's start with that. So if we wanted to close this one today, we could for a nice profit. So we could close that for a 95% profit right now, approximately. We took in a credit of 83 cents, and we could purchase it back for 3 cents. However, we did not issue that trade alert, and I'll show you why right now. So first of all, the fundamental analysis of the market is still very supportive right now. We don't have rising rates. The big thing is inflation continues to be low, and so now the banks have no reason to raise rates. And sure, perhaps there's a bigger story that the corporations are taking on huge amounts of debt and then using that to subsidize the prices of their products, which is suppressing inflation. And perhaps the central banks are encouraging that sort of malinvestment, perhaps. But regardless, if the banks are loaning out money super cheap and the bond market's paying you nothing worldwide, you know, you have nowhere else to invest your money. And so if we look at the trading volume today, there's puts on the left or rather puts on the right and call options on the left. And let's take a look right here at this 293 strike. We have 46,000 contracts flowing through that strike this morning. That represents 46 million shares of the SPY. That's quite incredible. So and this is just till tomorrow. So people are betting that much money on the 293 strike on a trade between today and tomorrow. So I am expecting a rally between now and our next trade alert Friday. So we'll realize probably close to 100% profit on that 95 strike that we rode yesterday, and we'll just repeat this tomorrow. So it's not a time to panic, because let's say we did panic and we covered that today, like one of the members who wrote in did. I'm not sure if you're on there, but I wouldn't do that today, because now if I were to cover it and write this new one right now for $1.25, well, the market's betting we're going to skyrocket up to 293. So we already made 100% profit on our covered call almost overnight, and now we're just letting the market have a little volatility. The option market is clearly placing its bet on the upside between now and Friday. And so that's why I'm not going to rush out and say, hey, let's put on our hedge, let's start shorting the market. I think really we had a lot of put option volume flow in yesterday, which I mentioned was probably the first time we'd seen it all year, really. And so it looks like the people who'd put on those bets were able to simply sell a lot of SPY shares, get a little bit of a crash, and probably cash out those puts. And so now I think we're going to see the opposite reverse. Now, come tomorrow, if the market has not had a rally, then sure, we'll cover that position and start looking at some of these in the money covered calls. So now that there is a little more volatility, let's take a look at some of the potential trades between now and Monday, just to get an idea of what we could potentially see for tomorrow. Now, if we see the market rallies back towards the 293, we'll probably be less defensive and be writing that covered call right in the money or slightly above the money, depending on what the option market is telling us is going to happen. But if the market does stay in this range, we might look at a more defensive trade. And so right now, if I were to go all the way down to, let's say this 288. Okay, so the current trading price is 290.82, and in this covered call, we would be agreeing to sell our shares at 288 for a $2.81 loss. Now, why would we agree to such a crazy proposition? Because the stock speculator will pay us $3.40. So if we were wrong and the stock market were to go up from this trade, we'd have a guaranteed profit of $60. But if the market were to trade sideways or down by up to $3.45, we'd actually earn a little bit extra because the call option would lose some of its value, plus the person purchasing the call option would lose the time value. So that's why we like to own the asset, Fred, because we can write the covered call and set us up for a multi-directional winning opportunity. And the odds of that trade right now is at a delta of 78. So this trade right here would have a 78% probability of winning for us. Now, when the market has no reason but to melt up, that's when we do go for a little bit more risk, and we're writing that strikes either a dollar or two above the trading price. And that's how we get those double paydays and can have a potential return in the 50 to 65% range. When we start doing trades more like this, where we're writing the strike price in the money, now we're aiming for more of a 15 to 30% return per year with much less risk and a higher win rate probability. All right, so let's take a look. So right now, this portfolio is a $500,000 model portfolio. It has 1,700 shares of the SPY and 1,500 shares of the TBT. And so the TBT is going to be a good warning indicator when the stock market is starting to overheat. And so what do I mean by that? The biggest risk we have to the SPY would be a rise in rates, because if the bond market were to compete with the returns of the equities market, that's really our biggest fear. And so that's why our hedge, the place we put all our extra cash, is this TBT inverse 20-year treasury. And so right now, this has just been kind of trading around in that 32 to 34 range. But my expectation would be for this to rally just like it did last year. So we can see right before that sell-off in equities, we can see that the TBT had a huge run-up all the way from 35 to 41. So this is something that will most likely slowly creep up alongside the SPY. Okay, we got a quick question. Why not let the option expire worthless if the price doesn't reach the 295? Okay, good question, Paul. So we're not in the game necessarily of trying to get the highest return per trade. We're in the business of trying to have the most trades that are profitable. So if I were to let the trade expire worthless on Friday, I wouldn't get to rent out my SPY shares over the weekend. So in order to have our, I like to relate this to owning an apartment in New York City. We're not too worried about what the real estate value is in real estate in New York in the short term, because we're planning to own this asset for decades and rent it out and rent it out and rent it out. And so the only way you'll be able to make that income over the weekend is by purchasing it back. And it'll probably be for around a penny by tomorrow. So yeah, that's the name of the game. There's going to be volatility in the underlying asset, and that's why we have this opportunity to write these covered calls. So yeah, that's the reason why we want to get 3 times a week. And also between Friday and Monday is one of my favorite periods, because all we have to worry about is the market's closed over the weekend, so we really have less than a full trading day, but we still get almost the same premium. So that's one really nice thing. There's not usually a lot of news that flows through the weekend that really impacts the markets. Now, sometimes there might be some earnings after hours on Friday, but other than that, it's relatively easy period to cash in on. Okay, so that's what's going on in this program. Let me pull up that trade alert just so we can take a look at it. So we were at a 7.3% return yesterday, and we started off by closing the 294 strike. Let me zoom in so everybody can see this. And then we wrote the 295 for 83 cents. Now, one thing I do want to point out is that while everyone else most likely is pretty scared today, especially if they're a day trader, if you were betting on the market going higher and higher, and all of a sudden you get this quick turnaround, probably a lot of volatility in people's accounts, especially if they're trading, companies like Netflix or Nvidia or some of these hot names that are low market caps. They're going to be seeing a lot of volatility today. But what about us? We have the SPY ETF, which is less volatile than any single security, number one. And number two, even though the market flew down about $4, we only show an unrealized loss on the SPY of about $3.17. So we have about 25% less volatility than anyone else who owns the SPY. And if you then compare our portfolio to anyone who's holding small cap stocks or whatever particular companies they've handpicked, most likely they're seeing a lot of pain and freaking out today. In our portfolio, we're not really worried because number one, the outlook for the SPY is great. We have strong growth in America while the rest of the world is really just getting beaten down, and our central bank has a more prudent fiscal policy than all the other central banks, which is making the dollar stronger and stronger. The corporate profits are at all-time highs. Corporate buybacks are going to be at all-time highs this year. There's a little period where they can't buy back right now because of all the earnings. So these are all the reasons why I'm just not worried about this little bit of volatility today. Now, if China deal was breaking down, if the Fed was hinting that, yeah, it's time to raise the rates up, those would probably be the two things that would really scare me right now. And if I were scared, rather than going for the double dip trades, which is what we've been enjoying this week, where we write the covered call above the trading price, I'd simply be moving it lower and lower and lower. So that's where we get that 15 to 30% annual return, but with a lot less risk. So right now, my expectation is really that we're going to break into into new highs until the rates do start to catch up. And so with that mindset, I would not cover yesterday's trade because I think the underlying asset is going to give us a nice boost between now and Friday. Now, if it doesn't, we will react accordingly and follow the market in the direction it travels. So that's just a heads up on what I'm thinking, mindset and reaction to that sell-off. So the market certainly expected the Fed to lower rates by 50 basis points, and I think that's what gave them enough worry in the market to at least create a little volatility today. Now, I do want to point out, in the long run, we really look forward to volatility. And so the higher the volatility, the higher relative value of options. And so the higher the volatility climbs, the more premium we collect while being able to push the strike price further and further from the trading price. So in the long run, if we can get this volatility to stay a little bit higher, you're going to see that our potential return creeps higher and higher and higher as the volatility climbs. And this is interesting. So here's a screenshot from yesterday's trade alert, and you can see, and this is something I pointed out, is that there's an unusually high level of option volume yesterday at that 294 strike, and a relative amount right here at that 294. So we did highlight that. That is one reason why we went to the 295 instead of the 296. Now, if we had gone down to the 292.50, we'd be seeing very little volatility today. And perhaps that's just bad timing. If you've been following the program all year, I've been doing very cautious in the money covered calls week after week after week after week. And I did not expect a rate hike today, so or rather yesterday. So that's why we went right at the money with yesterday's trade. So that's a good overview of what's going on in the basic program. Tomorrow we will cover this position, and the process for that, I'll just show you guys what kind of the daily process is Monday, Wednesday, Friday. So what I do is, for you guys, I like to keep the new trades up top. You could be just placing your trades below if you like. So I paste that to there. And so all this is doing is getting us ready, and we'll push a fix through to everybody's sheet to take care of that ticker that's changed on everybody. So we'll get rid of that B, and that just happened overnight. So now I'll move this down to here. And so we could be closing this position out for a near 100% profit today, but there's no need to do that. We'll do that tomorrow, right before we write the new one. Now, when we do put it, that will just be plopped into there. We have the number of contracts, and then we're ready to write the new trade tomorrow. So I'll just set that up. A lot of people don't like to use spreadsheets, and that's not a problem. If you don't like to use spreadsheets, you can see how easy this is to do just in your head. You just really need to keep track of how many shares of the SPY ETF you have. So for every 100 shares, you can do one contract. All right, so that's a good overview of what's going on in our basic program. Let's go ahead and take a look at our diamond level program. So again, this portfolio is ideal for folks who want to have the most security. They're happy to trade 3 times a week at noon. It's a 2-minute trade and really doesn't need the spreadsheet. If you want to take it a little more advanced, we can look at what the SPY ETF actually owns. So let me just show you guys what the SPY ETF is all about. Why is it the highest traded security in the world? And so right here is a chart of ETFs and trading volume. And we can see that the SPY ETF trades 61 million shares on average per day at a rate of $290 per share. There's nothing else that comes even close to the SPY ETF. And that's because it outperforms all hedge funds. Ray Dalio was the highest paid hedge fund manager last year, pulled in $2 billion. And what's funny is he's done this underperforming the SPY. His big pitch is that he'll reduce your volatility. He manages about $140 billion fund. But in general, the hedge fund industry has had more shutdowns and closed businesses than ever before in history last year. And it's primarily because of the SPY ETF. It's also wreaking havoc in the mutual fund world. Why pay extraordinary fees when you can just buy the SPY? And there's almost no one out there who can outperform it. Perhaps the only hedge fund that really has outperformed it is James Simon, who, lo and behold, was the second highest paid hedge fund manager last year, coming in at 1.5 billion. Now their fund is closed doors. They have about 166 PhDs. They're completely doing artificial intelligence trading. But anyways, the point is that the SPY is popular because it works. It diversifies your capital into the top 500 companies and reduces volatility with no work. You buy the SPY, you sit back, that fund does everything for you. But how can we actually do better than the SPY? Well, you're not going to do better than the SPY trying to outthink it, okay? But here's a little secret that will help you outperform the SPY. And the secret is, if you can't beat them, join them. What does the SPY take and purchase with your capital? Well, here's a look at what it does. And just to give you a feel for how diversified the SPY ETF is, the top position is less than 4%. Now ask yourself right now, does your portfolio have a single position that's greater than 4%? And if it does, is that company Microsoft, Apple, or Amazon? Because if the best performing asset in history has a total allocation of 3.8 in Microsoft, you gotta ask yourself, am I really making a smart choice with how I'm allocating my capital in the markets? And when you start to think about what's really driving the demand for these securities, well, the SPY ETF is probably one of the biggest buyers of these different companies. So if we look at where it's going to automatically flow its capital as money flows into the SPY ETF, it gives you a good idea of where the safest place to park your cash is for a long period of time. And so our Diamond program is not trying to outthink the SPY. It's just trying to replicate what the SPY is doing. Now, of course, our average client doesn't have enough money to buy 100 shares of 500 companies, and we don't recommend you do that. In fact, I believe we live in a world where the big companies are gobbling up the small companies. So there's no need to buy the bottom portion of the SPY. What we're most interested are the key players at the top who are most likely going to continue expansion into more and more markets. And so that's been the trend. Amazon is just insane with how well it's able to take over markets. Anything it touches, the competitors crumble. So a lot of the companies in that S&P 500 are competing with these companies up top. And so that's a big reason why our Diamond program has performed so well. Now, the other important ETF is the QQQ NASDAQ 100. And it's a very similar, we can see in the top three, we have Microsoft, Apple, Amazon. And in the top three in the QQQ, we have Apple, Microsoft, Amazon. So we can see a very concentrated amount of capital from the two highest traded ETFs in the world flowing straight into the companies we recommend at Portfolio Builder. And that's critical because we're trying to teach you how to stop turning your portfolio into a speculative guessing game. Instead, let's turn it into a miniature investment bank And instead of loaning out dollars, we're teaching you how to loan out shares of equity. So the other thing I want to point out is Berkshire Hathaway is a big company in the SPY ETF. Let's just see what position it has. It is 1.6, so it's pretty big. And what's crazy is how small the staff is at Berkshire relative to Facebook, Amazon, Apple. I guess once you look at all the companies Berkshire owns, they have quite a staff. But what he's built single-handedly almost is just incredible, and it sits at the 5th largest position at the SPY. But what does Berkshire's portfolio consist of? Well, it does have a huge cash position of about $100 billion or so. But of the equities it does own, we can calculate that half is concentrated in Apple, which is also top position in the SPY and QQQ. Then we got Bank of America and Wells Fargo. Okay, so we know where all the money's flowing on autopilot because of these ETFs. And that's why this portfolio has performed twice as well as the SPY. Not only do these companies get the bulk of the capital coming in from the SPY and the QQQ ETF, they also have the most profit. Because they have the most profit, they have the most corporate buybacks. In a world where rates are low, the monetary supply is expanding. Who wants to own dollars? Why does a central bank want to create 2% inflation? That means the value of your dollar is going to lose 2% a year. And that compounds pretty quick. So where's all that value going to flow to? To investment assets. Okay, so that's why these companies, without even thinking twice, would rather put their cash into their own stock. They can use those shares to do buyouts and mergers, and not watch their capital just melt away because of policies of the central banks. So when we look at this portfolio, we can see that our target is, and I gotta push this back, we're tweaking this in the last webinar. So we can see the allocation in this portfolio is a 20% position in Microsoft. Now this is most similar to the SPY ETF, not in its diversity, but in its premium and its historical volatility. The Microsoft company has such a monopoly on the Windows platform, and now it's expanding into games, clouding all over the place. It continues to be the #1 company in America with the least volatility, and it's really the staple of this portfolio. Now, it has the least covered call income because of that. If we look at a chart of Microsoft, it's just almost a straight path up. And so that represents 21% of this portfolio. The next positions are these tech companies, which is a mix of the top positions in the SPY and the QQQ. And so we can see that we get a 12% position into Apple, a 11% position in Facebook, and then it really gets quite smaller at 2, 3, and almost 5% into Intel, Cisco, and Comcast. Now I do want to mention, look, we don't have Amazon in there and we don't have Google. Now, surely those are two companies that will continue to grow. Google's had a little hiccup lately, but they're doing so much investment into artificial intelligence and other sectors right now that they're setting themselves up to continue to dominate and take over more and more markets. Amazon is just a profit guzzling machine, but you get that exposure when you own the SPY. So all of that exposure is covered with the SPY in our product, and we've left it out of the Diamond Club because you'd have to have over 100 grand per company just to hold those positions and be able to do the covered call. So that's why they are pulled out of this Diamond portfolio. But at the end of the day, we end up with 300 shares of Microsoft, 100 apiece of Apple, Facebook, Intel, and Cisco, 200 in Comcast, 900 at Bank of America. Now we're looking over at Berkshire's two main positions. and we get Bank of America and Wells Fargo. Now let's just take a look at some of the trades we put out on this one. So our defensive plays did well on the Microsoft trade. We can see the strike is now sitting above the current trading price on Microsoft. So next Tuesday, most likely I do expect the market to rally back, but we'll probably get to keep the bulk of the profits on that covered call, and our defensive trade on that one paid off. Apple is continuing to outperform. Yesterday when everything was down, Apple was still up 5%. And it's not because they have increased revenue. The reason their stock's up so high is because they announced a huge buyback program this year. So these companies are all going to keep buying back their stocks. The Facebook trade, our strike is right below the current trading price. So that trade's doing very well. And then over here, our strike is a little bit higher. I'll have to check what's happened on Bank of America and Wells Fargo. These are two that we did no covered call on. But as we speak, this portfolio is sitting on a $22,803 profit, starting with $150,000 capital, and it only trades on Tuesdays. So if you want to trade less and you want to go for a little bit higher return, the advantage of this program is that we can now set our strike price at different levels per security. When we do the SPY program, we have to just have one overall prediction and one strike. But when we do this strategy and we purchase what's under the hood of the SPY, we can actually aim up or down based on what Wall Street's betting. And so Wall Street has a lot of money riding in each of these companies, and they use that option market to help hedge their bets. So that's a good summary of our two programs and where we're at today. Let me see what other questions we got today. Okay, Paul upgraded to Diamond yesterday. Yeah, I need to go in and unlock your Diamond, so I will do that for you right after the call, Paul. My apologies for not doing that yesterday. And we're up to 20 people today. Very good showing. What other questions you have out there today, guys? Oh, let me get Jerry's sheet. I'm gonna unmute it, see if anybody wants to chat too. No.
I just wanted to see if everything was in there.
Hey, Paul, post the email you're using right now. And I'll start filling out your spreadsheet right now for you, okay? Just as a demo for the whole group. If you want to do audio, let me know, guys, and I'll unmute.
Thousands of them is hard to believe, quite frankly, based on these exclusive documents that we obtained from the House Judiciary Committee. On June 23rd, 3 days after President Trump ended the separations by executive order, I was standing with Stephanie when that happened. A central database that would be used to get kids and their parents back together. But these emails that we've gotten between HHS and ICE show basically the exact opposite. HHS email.
I think that was a TV feed or something from one of our listeners. I'm going to mute that one. Yeah, we're getting to the audience size where if I unmute everybody, it gets pretty loud in here. So I go ahead and keep pushing your questions through. Okay, so we're looking at Jerry's sheet here. What did you want me to look at, Jerry? Anything in particular, or is this your portfolio now? And Paul, post me the email that you're using, and I'll pull up your spreadsheet and show you how you would get ready for Tuesday's trade alert. Fred, yeah, certainly. I would definitely recommend. Let me. Why don't you post your email, Fred, and I'll pull up your sheet too, and let me know what kind of portfolio size you're working with. But in general, here's what I would recommend. On the, if you have over 150K, I would put 150,000 into the diamond. Oh, you just want me to see if your spreadsheet looks good? Yeah, this looks good. I mean, you've been playing with your tickers again, but yeah, it looks great. I'll double check it, make sure it looks 100%. But yeah, so Fred, the SPY is your bread and butter and your safest bet. So anything over 150, I would put in the SPY. So if you're working with maybe $500,000, perhaps you put 350 in the SPY, or maybe 3. Let me pull up my other sheet. So if I had $500,000, I would probably put 50K into the emerging markets portfolio, where it's a buy and hold, and we're going for long-term growth. I'd put 150 into the SPY program, or to the high yield program, where we're getting these companies direct, and we're going to trade them on Tuesdays. And then the last 300,000 I would put into the SPY, because we have more protection, less risk, more diversity, and we're hounding that Monday, Wednesday, Friday. So in this program, due to the nature of its Tuesday only alerts, we're going to be trying to take a little more risk and make twice the return. Whereas in the SPY program, we're going to be much happier to get a smaller return and be able to protect it more frequently with the Monday, Wednesday, Friday trade. Okay, so we got another question about. Okay, let me expand my question box. We got a bunch coming in. Okay, Fred says, do you feel Robinhood gives fills comparable to Interactive Brokers? Yeah, so Fred, they all fill through the same liquidity pools now. So it's going to be the same rates everywhere, for sure. So I wouldn't worry about that. And we're also not trading, we're not trading penny stocks. We're not even trading small cap stocks. What we're trading is the best of the best of the best. Not only are we pulling the top traded in terms of liquidity and volume, this is just the top echelon of possible securities you could put in your portfolio by every metric. Most profitable, highest level of growth, biggest corporate buybacks, and plus they're the top positions in these key ETFs, so they have a guaranteed flow of buyers. So certainly the liquidity and the spreads on the prices are going to be instant. You'll get these filled within seconds. And now Interactive Brokers will be better for your 401k. Robinhood will be a tiny bit better for your non-retirement funds. So Interactive Brokers is very cheap, reputable company. If you're not super confident in how to do a covered call, which is probably the easiest trade in the book, they may have a little bit better support. But Robinhood has the phone app, so you can do this on the go, 2 minutes. It's really a 2-minute trade on the SPY. Now, the Tuesday class, I would say, we're doing 8 securities, so you're going to have to cover 8 positions and write 8 new positions. So that might take you more like 20 minutes. But with this one, it's really worth it. It's a little more work. You're basically building a concentrated version of the SPY, but your power is so much expanded because now we can write strikes per security. And as you noticed in the Tuesday alert, if you're in the Diamond program, I wrote in the money covered calls on our biggest positions and out of the money covered calls on our smaller positions. So I gave our Diamond portfolio a good level of cushion going into the Fed meeting this week, while leaving some of the riskier assets that have a smaller position size, namely these 3, plus the banks, were set up to give us some growth. Neil's asking, what's the cost to upgrade to the Diamond? Yeah, so most of you came in for $897 for the basic program. We do have a really good deal to get into the Diamond program right now, where you pay $2,000 this year, and it counts for your total costs for both the basic, the emerging market portfolio, and the Diamond. And then the following year, you'll be billed $2,797. So that's about a $1,400 savings on our normal $5,000 a year rate on the Diamond. But to put things in perspective, the Diamond program, if you have 150K, is averaging $4,200 a month of income, and it's doing it with really conservative covered calls, mostly in the money. So to get that kind of return while having protection on your asset is pretty unheard of. So I do think it's a really good deal. We also have a quarterly option that doesn't save quite as much money, where you can pay $897 a quarter to get into the Diamond program. So I'll definitely have someone reach out to you for that. We got a bunch of questions coming in. Let me see what we got. How do we protect against crash? I'll go over that in a second. Let me, and Paul, I'll pull up your sheet in a minute here. So we'll get you ready for the Tuesday trade. Okay, I have a question. I am brand new to this, inexperienced in trading. I'm at level 0. Where do I start and even learn how to write these trades, and what day do I start? Good question. And that's perfect. I really want the newbie questions to come through because there's no bad questions. Most people are just too shy to ask entry-level questions. And I'm actually planning to hopefully get a lot of this content redone this weekend. But if you go to our quick start guide, well, first of all, I'll just show you how easy it is to do these trades so you can see just how easy this is. Let me zoom in so you can really see my screen well. All right, now that's a nice zoom in shot right there. Maybe too zoomed in. So a lot of people always ask me, do you do spreads? Do you do butterflies, calendars? You know, there's a million different option strategies out there. And I always tell them, no way, Jose. And not only is it not a good idea because of the amount of risk it entails and makes it a much more complicated thing to follow, it's just not the way the option market was designed. The option market was designed to protect equity. It was not designed to get rich trying to guess market movements. And so 99% of all option advisory products in the market, they're trying to use the options to allow you to use a lot less capital and try to get rich with predicting moves in the stock market, or predicting, you know, if you're doing iron condors, you're doing the opposite, trying to predict no move in the market. Our product's not like that. We're trying to own the most popular assets that we can trust will grow in value over time, and then simply rent them out to stock speculators who don't understand what the point of the option market is. And so these folks who want to bet that the SPY ETF will jump up $2 to $3 every Monday, Wednesday, Friday, well, good luck to them. We're going to take their money and not think twice for the rest of our lives. That's just a very repetitive, easy strategy that makes a lot of sense. We're turning this into a business instead of a game. Okay, most people out there trade like it's a game, a fun game where they're going to try to guess what's going to happen. There's no guessing in our product. We're really just owning the best assets, and we judge that by the demand. The demand for these securities is greater than any other securities in the world. So that's step one. And then step two, we have an easy way to rent out these securities to gamblers. Okay? And so it's just really that simple. But let's just show you how easy this is to do. So step one, you're going to have to buy 100 shares of the SPY. I think most people know how to do that. Now, go Mark, go. Is that something you feel confident you could do? Is purchase 100 shares of the SPY ETF? And which broker are you at right now? Yeah, what broker are you using right now? So just in general advice, okay, if you're using TD Ameritrade, that's a great place to get started because you could literally call in this order and they'll fill it out for you. Now, are you going to make the maximum return using a premium brokerage such as TD Ameritrade? No, but are you going to get the education so you can do this on your own? Sure. So TD Ameritrade's great. Thinkorswim's wonderful. If you do get on the horn and threaten them that you're going to go to Interactive Brokers and they have better rates, they'll give you a good deal. Okay, so step one is you got to buy the stock. Step two is sell to open. Okay, and we're always going to be going one expiration date out. So tomorrow's trade will be for the 6th. The strike price will be given to you. Okay, so that's how we write a covered call. Now, this is the safest kind of trade you can do because we're not setting ourselves up with some sort of highly leveraged option trade. Let's just explain what this means. If I sell to open one May 6, 2019 292 call options for 80 cents, I'm basically agreeing to collect $80 and am agreeing to sell my shares to the person buying this contract for $292. And that's a good deal because look, right now the SPY is trading at $291. So this guy's saying, hey, I will pay you 80 bucks for the right to buy your shares for $292. So that's a crazy deal. This guy is literally going to pay us $80 to pay us an extra $100 maybe if he's lucky and the SPY skyrockets up from here till Monday. And that's actually what I do think will happen based on that option volume. But regardless, that's a great situation to be in. And the reason we can be in that situation is because we've saved our capital over our lives and we can afford to buy the asset. So if a stock speculator says, hey, I want to pay you 80 bucks to borrow your shares over the weekend, and if I do want to exercise my contract, I'll pay you an extra 100 bucks. That's a good deal. If he's wrong, you keep his 80 bucks, you keep your shares. If he's right, which is going to be a very rare thing, it's still good for us. We pulled in 180 bucks per contract, and we'll do it 3 times a week. If you collect 100 bucks 3 times a week, 52 weeks a year, that's $15,600 of income just from renting out 100 shares of the SPY. Now, we're not always going for 100 bucks. A lot of the times we're going for more like 25 to 50 bucks. But that still inks out a 15 to 25% annualized return, even if we're being super conservative. So that's why this is the best retirement strategy, and really just the way, this is the best way to pull money out of the option market with the least risk. Okay, so we got some more. Okay, so go Mark go. So step 1, you buy your shares. Step 2, you're gonna enter a option contract. So you're writing an option contract. It's click of a button. It's going to take you 2 minutes to get that going. And so then on the expiration date, so that would be on Monday. The trade we're in right now is this one. Let's just look at the trade we're at from last week. Or from, from Wednesday. So yesterday we collected $86 for some fellow who wanted to pay us $295 a share. Well, he's not going to be paying us $295 a share. He lost all his money, poor guy. So tomorrow we will have to cover this position. So we're going to cover it by going to buy to close. So when we sell to open, we're going to get a credit of 100 times the mid price. Okay, so if we were doing one right now, we would probably push it down to 291. Okay, so in this example, we're agreeing to sell our shares for 291 while it's trading at 291.11. So we're agreeing to an 11-cent loss if we did sell our shares. But the stock speculator says, well, hey, to make it worth your while, I'll pay $100. I'll pay you $1 per share. And so now you get to see, this is the game. This is the gambling game. You know, if you think about the casino, you see those crazy guys going from table to table to table, just blowing all their money as fast as they can. This is how you play the casino. Now, is it completely risk-free? Of course not. Every once in a while, someone's going to get lucky. But in this situation, when the gambler gets lucky, we don't get hurt at all. And really, our only big concern is a fast market crash. So I'll spend the end of the webinar talking about that in a minute, about how I would react to a market crash. Let me see what other questions we got piling up here. Okay, let's see what other questions we got piling in here. Okay, so we sell to open, buy to close, drop the date to the next date, sell to open, we might be moving the strike around. Okay, we wait 2 days, now we're gonna buy to close. And we're gonna drop the expiration date, sell to open. So this is a strategy that you can do for the rest of your life, okay? If you join our program, you can see my little input as to where to put the strike, but you're gonna get the flow. You're gonna see, I go look at the option chain, I look where Wall Street's betting, and generally I go $1 or $2 below that because I wanna play it safe. I'd rather have a smaller return with less volatility than a greedier return with more volatility. And that's because our audience is not in a growth stage of their life. They're really in a conservative stage of their life. So that's it. That's a very repetitive process. In 10, 20 years from now, they're probably going to have daily options. So instead of having 156 paydays doing this a year, you know, take out the holidays. What is there, like 14 holidays a year where the market's closed? You know, you're looking at 350 opportunities minus the weekends to be renting out highly desired SPY shares to gamblers. Okay, now let's see what other questions we have coming in here. Okay, do I have to be on these calls every day to do this? And do I have to make my trades immediately? No, but we got folks like Henry. Hey, Henry, let's see if Henry's listening. I'm gonna unmute Henry. Henry, how's it going, buddy?
Good morning. How are you?
Doing good. So yeah, Mark, we have people, you know, Henry's got a huge account following this strategy. He joins the webinars, likes to give me a hard time, but you don't have to be on the webinars. How long do you think it takes you to do the trades, Henry?
Oh, less than a minute.
Less than a minute. I've been quoting 2 minutes.
Okay, 2 minutes.
So yeah, it's you know, there's no magic sauce in this product. What it is it's really smart. It's very consistent, and it gives you a way to protect your capital. So in a minute, we're going to switch gears and focus on worst case scenarios. Everybody always wants to know what's the worst case scenario. So let's see what other questions we can pull out of there before we end it on talking.
Hey, Jason, I got a quick question.
Sure.
How come we aren't taking our trade today? And I came in late. I just came in. I'm actually traveling. How come we aren't taking our profit today and moving on to another trade for tomorrow?
Sure. Yeah, we did cover that. Let me just cover it one more time.
Oh, you did cover it? I didn't get an email.
Yeah, I didn't email you guys. So let me cover that question. That's a great question. And in fact, we had one of my old clients back when we were doing all the crazy option spreads and all that. I'm not sure if he's on today. He had covered his position. So, okay, so there's a number of things. Let me pull up the data here. So, okay, I think that the market was hoping for a 50 basis point cut yesterday and they didn't get it. So maybe that was creating a little bit of the volatility at the end of the day. But here's a few things. Number one, I do think that one sec. Okay, so here we got this pulled up. Let me pull up the next two expirations. Okay, so number one, the option volume on the call side is exploding today and it's pointing at 293 for tomorrow. So I don't want the underlying asset to appreciate and lose that jump tomorrow. So I'm happy with the 100%, nearly 100% profit on that 295 covered call. And if we were to write the new one right now, it would be because we were worried about further downside. But at this point in time, I'm worried about a break into new highs. So number one, Fed's not raising rates. Number two, inflation is low. And so they have no reason to raise rates. Number three, we're sitting on that 3.2 GDP quarter one. The best estimates anybody had was 2.5. So that fear of a slowdown was muted. Three, all these corporations are going to be getting out of their blackout period. They're all releasing earnings, so they can't buy their own stocks right now. Four, China trade deal is probably going to be announced in the next few weeks. So I don't want to be playing it super safe right now when I think the market's going to fly higher. Now, come tomorrow, if the market doesn't pop up, sure, we'll take our $200-300 loss per contract and start playing it safe. But yeah, I think today's a good day to just do nothing. So we did nothing and just being patient. But yeah, look at that, 48,000 contracts flowing into that 293 strike. This is money that's betting on, what is that? It's like $80 million betting that the SPY is going to pop to 293 by tomorrow. That's crazy. So Wall Street's certainly betting we're going to go back up. And sure, there is a lot of volume on the puts, so I'm definitely watching that carefully. But yeah, I think that somebody owns a lot of SPY, wanted to try to play with the market yesterday. We saw in the alert, I'll show you yesterday's alert. I was pointing this out. I was like, hey, this is the first time. Let's take a look at the volume of yesterday relative to today. That's impressive, huh? But I was pointing out that, hey, for the first time, we're actually getting a little put option volume in there. Are they worried they're going to increase rates? And so that's why we have that TBT to protect us against that. But no, they're not raising rates. And so I think someone was just trying to goose it for a quick profit on their puts. But the market's leveraged to go up. So I'm going to be careful to make bets on the downside. And so yeah, so basically I think that the underlying asset may have a big jump that would be a lot more exciting than trying to pull, what could we pull out? If we did right at the money, we could get 99 cents today. But if the market's going to fly up $2 or $3 between now and tomorrow's trade alert, I think it's a good time to just be a little patient and not over trade.
Gotcha. And did you switch your trade alert from 1 o'clock to 12 o'clock Eastern now?
Yeah, so the flow of content is Monday, Wednesday, Friday at noon will be our trades. And I really don't want this to be a product where you think you have to show up Tuesday, Thursday. Tuesday, Thursday is optional. Now, if there's an emergency, I will text message and email everyone. Instead of trade alert on a Tuesday, Thursday, it's going to say emergency alert. And, people like Fred are always wondering, is this program too good to be true? Well, Fred, we get in a hissy if we lose like $30 in this program. So we're very anal about not losing money. But the flip to that coin is we're not trying to make huge returns. This is all about trying to have a very consistent business of being able to rent out our shares over and over and over again. So as soon as we clear out some of these just general questions, we'll go into the nightmare scenario and how our strategy stacks up to the rest. But yeah, so at this point, the option market's still telling me up. We got a nice 100% profit on that covered call or close to it. And so I think this is a time of patience will really pay off on this trade. Now, if market keeps going lower by between now and tomorrow, sure, we'll move that strike lower and we'll just play it safe. But I don't expect that at this point. Okay, let me clear out some of these questions coming in here. Okay, oh yeah, Paul wants me to pull up his spreadsheet and show him how to get the diamond going. So, okay, so Paul's one of our diamond members, and he's getting ready to start that up Tuesday. So I'm just gonna walk you guys through what it looks like to start up the diamond portfolio. So let me pull up his sheet. Yeah, you think I'd have that email memorized by now. I think you and Henry, I would say probably the top two attendees, and Jerry, top attendees for our program so far. Okay, I'm pulling up Paul's spreadsheet here. And we will close out the webinar talking about market crashes. That's really the only way we lose money, potentially. But I'm going to talk about what we would do during a market crash and why we may actually do better than normal in that kind of scenario. Certainly better than everyone else, that'll be for sure. Okay, I'm about to pull up Paul's sheet. Okay, Paul, you're still running on our old school spreadsheet, so I'll actually issue a brand new sheet after this call, and that will have all the tabs, but I'll just walk you through it on mine real quick so you can see. Okay, so the first step for anyone who wants to follow the diamond program is going to be to go to this section up here, and this will be your default setting. It's going to be 23% steady income. That goes to Microsoft. This is all color coded, so you can see that 23 matches that. Then we go to the high yield, 40%, and this weight level is how it determines the ratio to split up the 40% of your capital. So you can see how that breaks that down for you. We got 7% cash. Now this is a more advanced program, so I would actually be willing to use the option market to hedge this portfolio. In our basic program, we won't be using options at all. We're only going to be using stocks in terms of hedging. So, and then the covered call. So we'll write the options on this one, but we're not going to buy any options. Now in this more advanced program, I would most likely be willing to actually buy call options or put options to help hedge this portfolio. So it does need that little cash position. And we got the banks. So that's all predefined and filled out. You're gonna have to put your first deposit in to this area. This is how we keep track of how much capital you want to trade with the strategy. So perhaps 150 would go into there. After that, it's gonna give you a trade alert in this column E. And so that's going to tell you how many shares to purchase. This is relative to 150K. So you'll know right off the bat, you're going to need to get 300 Microsoft, 100 a pop on Apple, Facebook, Intel, Cisco, 200 at Comcast, 900 Bank of America, 500 at Wells Fargo. Okay, so over here, this is where we enter our stock trades. A positive means a purchase and a negative means a sell. And so this calculator automatically searches this row for the ticker, and then it can tell how many shares you own. So it's just a glorified color-coded calculator, nothing too crazy here. And then over there, this is where we write our covered calls. So I would not buy these until Tuesday so that you can put on the covered call right away. And because this only trades once a week, you'll see on the bigger positions, most of the time I'm writing the in the money covered call where we make, maybe 0.5% to 1% per week with a lot of downside protection. And then on these smaller positions, I'll typically write if Wall Street's betting up. If it's betting down, we'll still go for that in the money covered call. But if we can see Wall Street's betting up, then that's where I'll take a little more risk and do that strike that's a little bit higher up. So to review, step one, go throw in 150K or more into here. Step two, go throw your purchases into this area. And then step three, write your covered calls to protect your capital. So Paul, right after this webinar, I'll get you your new spreadsheet issued that will have not only the basic program, but it'll also have the emerging markets, which is still underperforming right now. So I know this hasn't been too hot of a topic with our audience yet. And then, of course, you have your diamond. Okay, let's see. How quickly do I need to be able to execute the trade once you tell me what to do? Okay, good question. So the SPY trade comes out at noon Eastern. You're gonna have to get that filled before the close. So the market closes at 4 Eastern every day. There's maybe like, sometimes these guys will let you sneak in orders after hours for like 10 minutes. But really within 2 hours of the trade alert is a reasonable reaction time. So that's how fast you need to react to that. Now you do get it via text message and email, and depending on who you ask, it takes between 1 to 2 minutes to do these trades. Okay, let's see what other questions we got. But Mark, what's important here is that you're buying the underlying asset and then you're writing a covered call. So these covered calls agree to sell your shares typically for a profit. Okay, so we're not entering a dangerous sort of option contract where if you don't understand what's going on, you're going to end up having to buy a huge amount of stock that you don't have capital to back. So all the option trading strategies that are doing spreads, short or long, they're really not a good idea. And I've represented every sort of option product you could imagine under the sun, and they're usually very momentum based. They do very well until the direction changes, and then you get hit in the head. And so that's the big problem with most strategies out there. You know, you follow the momentum, you buy the dip, and then assume the trend continues, and then it doesn't, and you get whacked and you lose. You know, in a lot of spreads, you can lose 100% if the direction goes the wrong way. In our product, if we lose 0.1%, it's kind of a big deal. You know, it was an unlucky day. But on the other hand, we're only trying to make 0.1% to 0.3. So we're going for 10 to 30 basis points 3 times a week. So that's how the JP Morgans of the world, that's how all these big banks, that's how they have years of profitable trading days with next to no losses. It's doing strategies that are something like this. Okay, so let's see what other questions we got out there before we talk about nightmare scenarios. What are you thinking so far, Fred? Are you thinking about doing the bulk of your capital on the SPY and maybe doing the diamonds on Tuesdays? And meanwhile, I'll go ahead and answer that. What do we do to protect against downside risk? All right, let's pull up. All right, so here's the chart that should frighten you going into the later stage of life. You need to generate a consistent income from the savings you have. You need to protect your capital, but you don't want to miss out on the, you know, the best part of a bull market. So that's kind of the feeling we have. And you know, this is a lot like the 1960s. Okay, so we had this very nice bull market. We had some pretty crazy sell-offs year after year. But they were bought back and bought back and bought back, and the market really looked invincible. And then what happened? Okay, we had the Cold War with Russia. We had a lot of government spending. We had a lot of things put into place to help reduce inequality. And we ended up with hyperinflation. We ended up with rates skyrocketing at the Fed. And we ended up with a period where if you had invested in 1965 in the Dow index, you wouldn't have broken even until 1995. So that's the nightmare scenario, is that you have 30 years of breaking even or losing money. So what do we do to protect against that? And that's the big question. So, I like to spend a lot of time listening to Bloomberg, reading Zero Hedge, listening to interviews on Yahoo Finance, Macro Voices, Peter Schiff. I like to get as many points of view as I can. But I also like to study history as much as possible. And this time period is probably the most interesting here, is between the 60s and the 80s. And this is really the biggest thing that influences the stock market, is the cost to borrow money. Now, if I can borrow money right now in the 2.5 to 3.5 range as a bank, and I can't invest in government bonds because most of the government bonds around the world are near 0%. Where am I going to put my capital? Well, there's really no option. You have to put it in the stock market. So if rates remain low, most likely stocks go up. Okay, and that period where we had this 15 years of downturn is when the rates went from 2.5% nearly to 20%. And what's scary are the number of similarities between the 60s and currently. So in the 60s, we were having this Cold War with Russia. We had a lot of movements trying to reduce the inequality. And sure, maybe that was a good thing to do, or whatever you want to say. But at the end of the day, what happened to force the central bank to raise rates and really wreck equity markets? And yeah, that's right, Mark. Now we have Cold War with China. You think it's going to be over with the announcement this week? No way. This is going to be probably 100-year Cold War with China. It'll probably last for the rest of our lifetime as the two battle for power. But yeah, let's look at the inflation during this period of time. And so, maybe this is not happening in Trump's reign, but what happens when we start to get some more progressive ideas going through politics? What happens when we get this modern monetary theory pumping trillions of dollars through the bottom-up scenario? Well, here we go. Here's what caused the central banks to raise rates. This is the historical inflation rate. And we can see going into the 60s, no inflation. Look at that. Let me zoom in so everybody can see that. Okay, prints between 1 and 1.6. Okay, and boy, they sure printed a lot of money in this period of time. Created a lot, Medicare, all kinds of, the government spending essentially just started to skyrocket during this period. And the growth did not match the monetary expansion. So we can expand the monetary supply when there's real economic growth and innovation, but when that gets ahead of itself, it turns into inflation. Prices start to skyrocket. And so you can see prices, we started to have hyperinflation in America, and that's why they jacked up the rates, and that's why the stocks crashed. So this is the biggest thing to really tune into in terms of what would force the hand of the central bank. Now, I do want to point out, it's not the only thing that can cause a crash, but it's the main thing. This is the main concern, is if inflation starts to pick up, then we have to start getting worried about rates rising and then having negative returns in equities. So if we can predict downturn, that's not a problem. And I'll show you how we can make the same boring return and then some while predicting that. But right now, that's just not happening. And so the big question is why? Why, after 10 years of the global debt rose to $122 trillion. The amount of debt piled on in the last decade is staggering. I think the monetary supply has doubled. So you'd think that inflation would be rocketing right now, but it's not yet. And so what's happening? Well, one thing that's happening is companies like Netflix and Amazon, and really most large corporations, they're willing to sell products at a loss and make up for it with the profitable sections of their company. So like the grocery business is getting destroyed right now by Amazon. They already wrecked retail. So they're willing to take little to no profit to come into a sector and take it over. And so this has helped keep prices low for quite some time. And so I think that there has been a tremendous amount of innovation and economic growth in the last decade. So that's one reason why I'm somewhat bullish right now, despite us teetering on all-time highs. So until that inflation starts to pick up, now there's a lot of things we can do to try to predict the inflation, and some very accurate ways to look at that. And unfortunately, the future of 2019 is most likely inflation rising and not decreasing. So we'll be keeping close eye on that. But if inflation does start to rise, that's where our TBT trade really comes into play. So let me pull up that TBT chart. So you might think I'm crazy telling people to buy the TBT if you just looked at the chart. From 2009, it crashed from $230 to $33. My expectation on the TBT in the next, the exact timing on this is going to be, when does the rest of the world realize America has too much debt, and that, this 2.5% 20-year rate is ridiculous. So right now, the central bank can artificially suppress the rates, which they're doing all around the world to help prop the equity markets and try to get through this slowdown in global growth that the world's seeing. But if we do go back to at least just an average over the last 200 years, that rate would go to 5%. And so that's twice the rate it is right now. And this is a 2 times leveraged inverse ETF. So that would put this at 140. So this is a great position to hold long term, unless you think we're going to have no inflation ever and 0% interest rates forever. So I'm not in that camp. Also, the biggest fear for the SPY would be the rising rates. So these two really trade well together. To own the TBT with the SPY makes a whole lot of sense. So that's one hedge we have in our portfolio, is that if there's a sudden shock in rates, TBT is going to fly higher, and that will help offset any sudden shock to our SPY trade. So that's important. So that's one. Two, Wall Street's pretty good at telling us what's going to happen on a day-to-day basis. And we just simply look at the option volume. So you'll see very quickly if the market does start to switch direction, the volume will go from, right now it's a little undecided. We've got quite a battle going on. I'll probably make some software that will quickly calculate all these numbers so we have a better average of where the market's really betting. But you can see there's more money on the call option side today than there's the puts, but it is much more evened out than it was for the most of this year. It's been very lopsided. So this will help us have a general idea of where the market's going in a very short-term basis. Now, why does that matter, and how can we do well in downside? So let's take a look. This is our favorite thing to illustrate for folks. And let's just say we thought things were going to get really nasty. Okay, let's see how far out. Well, let's see where there's actually trading volume. And you'll see once the market starts to head down, the volume will start pushing way below the strike price. So there's no one even worrying about anything below right here right now. So there's some decent volume on this 287. Let's just grab that. Okay, so this is what we call the in the money covered call. This is one of our most important trades with this strategy, and it gives us a very safe way to bet down. Anybody's ever tried to bet down in the stock market has probably lost money. I know I have. Even when I was right and called a crash, I didn't necessarily have the guts to pull the trigger, and that profit evaporated faster than I could even watch it occur in the first place. So trying to buy put options is very difficult, something you should do very rarely. So what's a better way to do it? Well, once again, that's where owning the asset, if you have 30 grand to buy the SPY, puts you in a huge advantage compared to someone who can't afford to buy that. So if you had less than 30 grand, you wanted to bet the SPY was going down, you'd have to buy a risky put spread, bear spread, who knows what you're going to do. But if you're wrong, you're going to lose probably 100% of your capital. What would happen if we wrote this in the money 287 covered call? So currently the SPY trades at 291.11. And in this covered call, I would be agreeing to sell my shares for 287. That's a $4.13 loss. So why would I take a $4.13 loss on my asset? Well, because there's a stock speculator, and I would say these are the smarter speculators that buy these in the money covered calls. He's willing to pay me $4.50. So while I'm willing to take a $4.10 loss up front, that's because it's offset by a $4.50 credit. So that's giving me $40 contract if I'm wrong. So if I'm wrong, stocks goes up, I get a guaranteed 40 bucks when the guy exercises his right to purchase my shares at that discount. I keep the option premium, he does even better, okay? But what if he's wrong? Well, as the SPY trades flat or lower, he's gonna lose in two ways. The time value is gonna depreciate every minute. So most of the profit we make in this product is called time premium. So that's really what we care about, is that we find speculators who want to predict market direction and they get it wrong. So every minute that they're wrong, their option contract loses a lot of value. So that's one. And then two, the intrinsic value of this call option will lose value. Now that is relative to our SPY losing value. So we're not making as much money from that depending on the speed. But it sets us up to have a situation where the SPY could travel $4.50 lower and we still make the same time premium plus some profit on the intrinsic value of the call option going down. If the market goes flat, we're going to completely earn our profit on the time premium. And if the market goes up, well, we have what I call the baked into the cake profit. So that's the first line of defense. Now, we're going to be reactionary to the market rather than trying to predict down moves before they happen. So typically that means we're not going to have these super conservative trades before a correction begins. Most people won't predict the market correction before it begins. But once it does start, we'll see the put option volume skyrocketing. And that's when we'll start going deeper and deeper and deeper in the money. So we'll be in a situation where we think there'll be a prolonged pullback in the market, and that's when we'll be doing these trades. So that alone is a very good way to make money in a downturn and protect our capital. And so that's our preferred way to do it because it's risk-free, relatively risk-free. Now, do we have a little bit of a way to enhance that return? Sure. Let me pull up. So in the basic program, we're not going to buy call options or put options. We're only going to write options. But we can get the same effect from these two this is an ET in, which is the VXXB. Now they just did change their ticker, so we'll have to go update everyone's spreadsheet. So this will go up if stocks go down. So this is a position right here. Now, if we did see, so first of all, I want to see some signs of inflation rising, rates rising. I want to see some signs of profits deteriorating in our core positions that are held in the SPY. I want to see conflict with China. I want to see something of that nature before I would even consider putting some cash into these inverse ETFs. But it'd be this easy. I would go, all right, let's put 70 here, 20 here. Software is going to say, all right, you're going to have to sell 400 shares of SPY, so you can now buy 4,000 shares of TEX and 2,000 shares of VXX. So, you know, why am I not doing that right now? Besides all the fundamental reasons we just talked about, you know, if we look at this chart, you know, VXX is at a very low price. If we look at TEX, yeah, super low price. Well, guess what? If we break into new highs, which is what it looks like we're on track to do, these things are going to go much lower. So, you know, you'd just be throwing money away. Much better off doing the covered call in the money. We're going to make money if market goes higher, and if market goes flat or slightly down, we're making the same time premium. We're collecting that time premium, and so yeah, that's really it. So if some of the fundamentals break down and the stocks really start to get in panic mode, we will do two things. We'll be writing the covered call probably 10 strikes below. So you can only go so low before you'd actually have a proposition where you would have to actually lose a little bit if you're wrong. But as the market starts to head down, we'll be able to go further and further and further risk-free. So let's see how far we could actually go right now. Yeah, there's just no one thinks the market's going to crash right now. There's just no volume going more than a few bucks down. So yeah, that's all there is to it for that. Now in the Diamond program, I'm assuming you're a little more advanced, and we have a whole section for long options, which go right here. So we buy our long options in this orange area, and then we close them over to here. But in our basic program, we get the same effect with less technical issues. So you just buy a TECS and the VXX when the time comes, but that's not now. What other questions we got out there today, guys? Let's see, I'll just unmute everybody if anybody wants to say a quick little thing before we let you guys go. All right, guys. Well, any other last questions out there? Paul's got ready for his nap time. All right, Paul. Well, hey, we'll continue spreadsheet soon out with the diamond level access, and we'll get you ready for Tuesday, buddy. Henry, it was a pleasure to have you on as always. Jerry, Fred, everybody, thanks for attending. And we'll have a new trailer out for you tomorrow, guys.
Hey, guys.
You're welcome. Fred says thanks for sharing your insights. Joy says bye. All right, guys. You have a great one, and we'll talk to you tomorrow. Thanks, man.